The income approach is one of the three methods used by real estate appraisers to determine value of a property. The income approach is more sophisticated than the other two techniques, and as a result, many real estate novices find it puzzling. Luckily, I'm here to help. Hello everybody, it's Zack here from realestatelicensewizard.com. Welcome to the video. Today we're talking about the income approach. So just a refresher, there are three different main approaches that appraisers use while they make an appraisal. They are the market data approach, sometimes known as the sales comparison approach, the cost approach, also referred to as summation, and then the income approach, which is known as capitalization. Each method has its own set of benefits, but we're talking about the income approach today. And the income approach is most prevalent for commercial properties with tenants because it relies on rental income. So what is the income approach? Well, the income approach is a process used by appraisers to determine the market value of a property based on its income. The approach is based on a finance concept of discounted cash flow analysis. Under the income method, the property's current worth is the present value of the future cash flows that the owner can expect to receive. Now, this method is most prevalent for commercial properties with tenants because it relies on rental income. It's calculated by dividing the rent collected, or net operating income, by the capitalization rate. So what is the income approach formula? Well, you can see it right on your screen. It's the net operating income divided by capitalization rate equals market value. So how do you use the income approach? Well, to comprehend the income capitalization strategy, we must first understand two other fundamental real estate concepts: net operating income and capitalization rate. Let's start with net operating income. After deducting operating expenses, but before deducting capital expenditures, debt services, and taxes, net operating income is the net income in a particular period. The formula for calculating net operating income is as it follows. So effective gross income minus operating expenses equals net operating income. So the appraiser will acquire access to income and expense accounts for the subject building and similar structures in the neighborhood to estimate net operating income. Having that information on hand allows the appraiser to assess the building's income and expenses accurately. Remember that all income and expenses are always annual values with the income capitalization approach. So the actual procedure of estimating net operating income can be broken down into 4 steps. Now I'm going to place all of these individually on the screen so that you can read through them if you want, but I'm just going to give a general consensus, perspective on each step. So 1, you need to estimate the potential gross income. So again, that is looking at the money generated by the building when it is rented at 100% occupancy. 2, you're going to subtract the amount of vacancy and collection loss from the possible gross income. So this is going to look at, how many vacancies potentially, or maybe non-payment rent will exist for the particular property. And then 3, you're going to estimate all building costs and deduct them from the effective gross profit. So again, there's going to be fixed, variable cost, property taxes and insurance would be an example of a fixed cost, while a variable cost might be something like repairs or snow removal, management fees, things like that. And then lastly, you're going to subtract the estimated expenses from the effective gross income. Then you will have your net operating income. So what about a capitalization rate? So with your net operating income, all that's left to do is find the capitalization rate. A capitalization rate is comparable to the rate of return in that represents the proportion of income that investors expect to get from a building. Appraisers learn to compute capitalization rates in various techniques. Luckily, on the real estate exam, the capitalization rate is usually given, or there's a problem with enough information for you to find the cap rate using basic algebra. If you would like to find the capitalization rate in real life, you need to look at recent comparable sales, such as buildings similar to the subject property being evaluated. On the exam, however, you'll see a question with the property's value and net operating income, and you'll have to find the capitalization rate. Luckily, this is way easier than it sounds, so let's do some examples. So if you have an income approach question on the exam, you'll see a question asking for capitalization rate or the property's value. First, let's do a cap rate question. So in order to find the capitalization rate, you just have to use basic algebra. Here's a super simple example. A property sold for $1 million and had a NOI, or net operating income, of $100,000. Find the capitalization rate. So knowing this, all we need to do is take our numbers and put them into the formula. So we have net operating income, that's $100,000, and we have the market value, that's $1 million. To find the cap rate, we just have to divide. So $100,000 divided by $1 million gives us 0.1, or 10%. 10% is our capitalization rate. It's that easy. Now, another income approach example you may see on the exam is finding the property's value. These problems are a bit more complicated than the last one. So here's an example. A property with a 15% cap rate, an effective gross income of $100,000, and operating expenses of $25,000. Find the market value using the income approach. So for this one, we need to find net operating income before we can find market value. So let's take a look at our two formulas. So the first formula, again, is that net operating income divided by cap rate. And then the second formula is the effective gross rate minus operating expenses equals net operating income. So first we have to take the effective gross income and subtract it by the operating expenses. So let's do that. So we have $100,000 minus $25,000 equals $75,000. Great. Now we have our net operating income. From there, we can plug in our numbers from the first formula. Luckily, they already gave us our cap rate. So with our net operating income, all we have to do is divide. So we take $75,000 divided by 0.15, or 15%, and that equals $500,000. So $500,000 is our market value and our answer. So what do you need to know for the real estate exam? Well, when it comes time for the exam, remember the income approach is a process used for appraisers to determine the market value of a property based on its income. You must understand the two formulas we went over today and how to use them. Remember, net operating income divided by cap rate is your market value. Then there's the effective gross income minus operating expenses equals net operating income. Know these two formulas and you will be sure to ace the exam. Still need help with real estate valuation and appraisal? Click the video here for more, and like always, make today magical. See you guys next time.